Imagine walking into a casino. Thousands of people are placing bets. Some are winning big, others are losing everything. Chips move across tables every second. The atmosphere is full of excitement, fear, hope, and disappointment. Now here's something interesting. The casino doesn't care who wins the next hand. It doesn't celebrate when someone loses. It doesn't panic when someone wins. Because the casino understands something that most people never do. Its success has nothing to do with the next hand. It has everything to do with the next 10,000 hands. Every game inside a casino is designed with a small mathematical advantage known as the house edge. That edge is tiny. In some games, the casino's advantage is only around 2 or 3%. On a single hand, that advantage means almost nothing. The player can easily win. They can even win several times in a row. But over thousands and eventually millions of hands, probability always begins to reveal itself. That tiny edge quietly compounds into millions of dollars, not because the casino predicts every outcome, but because it consistently follows the same rules. Now ask yourself this. If one of the most profitable business models in history is built on accepting uncertainty, why do so many traders believe they must be right on every single trade? This is where most retail traders lose. They don't trade probabilities, they trade emotions. Every trade feels like a personal test. This one has to work. I can't afford another loss. This setup looks too perfect to fail. And the moment that thought appears, the process begins to break. Because when you're emotionally attached to one trade, you stop following your system. You hesitate before entering. You move your stop loss. You close winners too early. You hold losers too long. Not because your strategy stopped working, but because your emotions took control. The irony is painful. Many traders already have a profitable strategy. They simply never allow it enough time to prove itself. Imagine flipping a coin that lands heads 60% of the time instead of 50%. Would you know that after 5 flips? Probably not. You could easily get 4 tails in a row. That doesn't mean the coin is broken. It simply means probability needs a larger sample. Trading works exactly the same way. A strategy with a genuine edge can still lose several trades in a row. That isn't evidence the strategy has failed. It's evidence that randomness exists. Professional traders understand this. Amateur traders fight against it. They search for certainty where none exists. They change strategies after every losing streak. They keep adjusting indicators, changing entries, tweaking exits, never realizing they aren't giving probability enough time to work. The casino would never do that. Imagine if a casino changed the rules of roulette every time players had a lucky night. It would destroy the very edge that makes the business profitable. Instead, the casino simply opens its doors again tomorrow. Same games, same rules, same mathematical edge. Day after day, year after year. That's exactly how successful traders think. They don't judge themselves by today's result. They judge themselves by whether they executed their plan correctly. Because they know something most traders forget. The market doesn't owe you a winning trade today. It only rewards consistent execution over hundreds of trades. And that's the mindset this entire video is about. Not predicting the next winner, not avoiding every loss, but learning to think like the casino, where every single trade is just one hand in a game that only pays those who stay disciplined long enough for probability to do its job. Now, let's go one level deeper. If the casino's biggest strength isn't predicting outcomes, then what is it? The answer is simple: consistency. The casino doesn't have a different strategy for every customer who walks through the door. It doesn't change the rules after a losing night. It doesn't increase its risk because business was slow yesterday. Every game operates exactly the same way, every single day. That consistency is what allows a tiny mathematical edge to become an enormous long-term profit. Trading is no different. Let's assume your strategy wins 60% of the time with a 1.5 to 1 risk-to-reward ratio. That's an incredible edge. In fact, it's significantly stronger than the edge most casinos have. But here's the problem. That edge doesn't exist on the next trade. It exists across the next few hundred trades.
1 trade proves nothing. 10 trades prove very little. Even 20 trades can be heavily influenced by randomness. You might have an amazing strategy and still lose 7 out of 10 of your first trades. You might have a terrible strategy and get lucky enough to win 8 out of 10. That's why small samples are dangerous. They create false confidence or unnecessary fear. Only a large sample reveals the truth. Around 100 trades, patterns begin to appear. Around 200, the picture becomes clearer. By the time you've executed 400 or 500 trades with discipline, your real edge becomes impossible to hide. But very few traders ever reach that point, not because their strategy failed, because they changed it before probability had a chance to work. Think about how many times traders do this. 3 losses, and suddenly they're looking for a new indicator, a different time frame, a different mentor, a different market. They aren't improving their strategy, they're interrupting the sample. Imagine planting a seed, then digging it up every 3 days to check if it's growing. It will never become a tree, not because the seed was bad, but because you never allowed the process to unfold. Trading works exactly the same way. Every unnecessary change resets the clock. Every emotional adjustment delays the moment when your edge finally begins to appear. This is why professional traders don't obsess over today's profit. They obsess over today's execution. Did I follow my rules? Did I wait for my setup? Did I respect my risk? Did I let the trade reach either my stop or my target without interference? If the answer is yes, then today was a successful trading day, even if the trade lost money. Because a perfectly executed losing trade is infinitely more valuable than a profitable trade achieved through bad habits. Why? Because good habits compound. Bad habits eventually get exposed. The market has a way of rewarding discipline and punishing inconsistency. The casino understands this. That's why it never celebrates a winning night and never fears a losing one. It simply keeps running the same proven system over and over again. Eventually, the numbers do exactly what they were always going to do: reveal the edge.
Now let's talk about the real enemy. It isn't the market, it isn't volatility, and it definitely isn't your strategy. The real enemy is emotional attachment to a single trade. The moment one trade becomes important, everything changes. Before you even enter the position, fear begins to influence your decisions. You hesitate. You wait for one more candle, one more confirmation, one more signal. By the time you finally enter, the price is already moved. Your risk is worse, your reward is smaller. Not because the setup changed, but because your emotions delayed the execution. Then the trade goes live. Instead of trusting your plan, you start watching every tick. Every small pullback feels dangerous. Every red candle feels like the beginning of a disaster. You check your phone every few minutes. You refresh the chart again, and again, and again. The market hasn't changed, only your emotional state has. Soon, the trade moves slightly against you, not enough to hit your stop, but enough to make you uncomfortable. So, you close it early. A few minutes later, the market reverses. It reaches your original target without you. Sound familiar? Now imagine the opposite. The trade keeps falling. Your stop loss is only a few points away. Instead of accepting the planned loss, you move the stop. Maybe it just needs a little more room. It'll come back. I still believe in the setup. But the market doesn't care what you believe. It keeps moving. A small, controlled loss becomes a painful one. And now something even more dangerous happens. Your next trade is no longer just another trade. It becomes a recovery mission. You're no longer following your system, you're trying to get your money back. That's exactly how traders enter the emotional cycle that destroys accounts. One emotional decision creates another. One broken rule leads to the next. Eventually, you're no longer trading your strategy, you're trading your feelings. The casino never does this. Imagine a blackjack table. A player wins 5 hands in a row. Does the casino suddenly change the rules? No. Another player loses 10 hands in a row. Does the casino feel guilty and offer better odds? Again, no. The rules were decided before the first card was dealt, and they remain exactly the same until the last hand is finished. That's the mindset every trader must develop. Your stop loss should be decided before you enter.
Your position size should already be fixed. Your target should already be planned. Once the trade begins, your job is no longer to make decisions. Your job is simply to follow the plan you already created while your mind was calm. Think about it. Who makes better decisions? The version of you before the trade, or the version staring at a flashing profit and loss number with adrenaline pumping through your body? The answer is obvious. That's why professionals make almost every important decision before they click the buy or sell button. Once they're in the trade, they trust the process, because they understand something powerful. The market doesn't pay traders for being right every time. It rewards those who execute consistently, even when the outcome is uncertain. Detach yourself from the result. Attach yourself to the quality of your execution, because in the long run, execution creates consistency. Consistency reveals your edge, and your edge is what builds lasting profitability.
Now let's look at trading from an entirely different perspective. Imagine it's the end of the year. Over the last 12 months, you've taken around 500 trades. Some were winners, some were losers. Some hit your target perfectly, others stopped you out within minutes. Now ask yourself one simple question. Which one of those 500 trades was the most important? The answer is none of them. Every single trade carried the exact same value. Each one was simply another data point in a much larger sample. This is where most traders completely misunderstand probability. They treat every losing trade like proof that something is wrong. But a profitable strategy is supposed to lose. If your strategy wins 60% of the time, it also loses 40% of the time. Those losses aren't mistakes. They're part of the business, just like expenses are part of running a successful company. A casino never gets upset because someone wins a jackpot. It was already built into the business model. Professional traders think exactly the same way. Losses are not failures, they're operating costs. The only real failure is breaking your own rules. That's why your trading journal should measure something different. Don't ask, did I make money today? Instead ask, did I execute my plan perfectly? Did I wait for my setup? Did I risk only what my plan allowed? Did I leave my stop loss exactly where I placed it? Did I let the market reach either my stop or my target without interfering? If the answer is yes, then today was a successful day, even if you lost money. Because today, you strengthened a habit that can make you profitable for years. Now let's talk about one final trap. After 3 or 4 losses in a row, almost every trader feels the same emotion. The next one has to win. But that's one of the biggest psychological mistakes in trading. Every trade is independent. The market has no memory. It doesn't know you just lost 3 trades. It doesn't owe you a winner. The probability of your next setup is exactly the same as it was before the losing streak began. That's why revenge trading is so dangerous. The moment you trade to recover your losses, you're no longer following probability, you're following emotion. And emotion has no statistical edge. Discipline does. Before every trading session, take 1 minute to remind yourself why you're here. Say this to yourself: today I will only take trades that match my plan. Some will win, some will lose. I cannot control the outcome, I can only control my execution. My job is not to predict, my job is to follow the process. Every clean trade moves me 1 step closer to revealing my edge. Read those words every single day, because success in trading isn't built by one great trade. It's built by hundreds of ordinary trades executed with extraordinary discipline. And that's exactly how casinos became one of the most profitable businesses in the world. Not by predicting the future, not by avoiding losses, but by trusting mathematics, respecting probability, and following the same rules every single day. So the next time you open your trading platform, stop asking, will this trade make me money? Instead ask, can I execute this trade exactly according to my plan? Because that's the only question professionals care about. Remember, you're not a gambler trying to win the next hand. You're the casino. The market is your table. Every trade is just one hand in a game of hundreds. Keep your rules, protect your capital, trust your edge, and let probability do what it has always done. Reward those who stay disciplined long enough. Thank you for watching. If this video changed the way you think about trading, share it with someone who needs to hear this message. And remember, don't chase the next winning trade. Build the process that creates thousands of them over time. The market rewards discipline, not emotion. Think in probabilities, execute with precision. And remember, you're not here to predict the next trade. You're here to master your mind. This is NeuroTrader. See you in the next one.